Crypto has taken off, with Bitcoin holding above 30,000 and Ether breaking through 2,000 after Wednesday's Shapella upgrade. Is this the start of a new bull market for crypto? Or is it just a sign of how weak everything else is? Our next guest is Jeffrey Tucker. He's the founder and president of the Brownstone Institute, former editorial director of the American Institute for Economic Research, and he's a big proponent of Bitcoin and the crypto sector in general. Jeffrey, welcome back to Kitco News.
Oh, it's nice to be here. Thank you.
Nice to have you. So we've got plenty to look at here. Let's start with Bitcoin. We saw Bitcoin hit lows around 16,000, 16,500 in December. We've seen steady legs up for Bitcoin ever since. And this week it broke out above 30,000 and it seems to be holding there. What do you think is driving this strength in Bitcoin?
Well, I mean, certainly 100% gains for the year is very sweet and very nice. It's pretty obvious that where the lows were. And anybody who has confidence in the technology, that was a very obvious buy opportunity, and not everybody does. I mean, it's so hilarious to me. It's, I've been in this Bitcoin for better part of 10 years. And every time it goes through one of these downswings, everybody panics and leaves the market. And then the smart money just sees it as bargains and goes for it. And then they benefit from it. And that's the case this time. So there's extremes on both ends of the crypto market, just because there's overconfidence and then a lack of confidence. I've never really understood it because, as far as I'm concerned, the proof of concept of Bitcoin was achieved once it achieved dollar parity. That's what, for me, the miracle was over. We'd finally invented the equivalent of gold for the internet age. Digital gold is what it always has been. We eliminated the double spending problem through blockchain technology and wrote a protocol that is a good sort of monetary policy, so we avoid all the chaos of the Federal Reserve policy that we've seen in spades over 3 years. And now you see Bitcoin is performing exactly what it's supposed to do, which is two main functions. I mean, one is to be a means of exchange, and that's great, but then also to be to work as a kind of the equivalent of gold, which is a safe haven for assets in times of financial, monetary, and economic troubles. And we're certainly in those. So why now? I think what we've seen over the better part of this year is a kind of a loss of confidence in the Federal Reserve in the management of monetary policy. But for better part of 28 months, they've been telling us that inflation is under control and that it's going down, and that it's transitory, and that it just keeps not happening. And the latest CPI release this week, was 5% annualized, but some sectors, 8, 9, and 10%, namely in food, and the really hot sectors keep migrating from sector to sector to sector. Now the PPI the next day looked a lot better, which suggests that inflation is finally going to get maybe under somewhat of control by the summer. But keep in mind that once you adjust the short-term interest rates for the inflation rate, we're still in negative territory, which means that you cannot save money in regular treasuries today without losing money. I mean, that is still true. That's been true for basically 15 years. So, during which time Bitcoin was invented and has been a tremendous performer in terms of security, and then in terms of profitability also. The latest banking crisis just underscored the point. The banking crisis that was arrested by promising endless bailouts, right? Guaranteeing deposits to 100% of insurance, even when the FDIC wouldn't statutorily enable it. The Janet Yellen on her own announced that this would be true. For all banks that she favors, for whatever reason, it just underscores the point that monetary policy is completely out of control. And there's other data points too we could go into. I mean, we've swung between 26% increases in the fiat money supply, at the height of lockdowns, And now we're seeing a plummet in the money supply that rivals that which we saw in 1931 and 32. So, and what the effects of that are going to be is yet to be seen. I don't think it's going to be good.
That's
Not
right.
to mention the high, not to mention the highest increases in interest rates we've seen on record, highest and fastest ever, and we're still not in real in the territory of what Jerome Powell calls the terminal rate of interest. So given all this chaos, I mean, it shouldn't surprise anybody with a brain that you have both gold and Bitcoin performing extremely well.
Yeah, well, let's drill down into some of this. You covered a lot of territory there. So yes, we saw CPI and PPI come in below expectations, particularly PPI coming in well below, but core rates for both remain high. And markets didn't seem terribly impressed. Markets were not excited with these numbers. The equities and the broader market did not take off. This is one of the things that lends credence to this idea that Bitcoin and gold are doing well because the Fed has essentially lost a lot of credibility over the last couple of years.
Entirely.
So what are
and this, by the way, is not entirely Powell's fault. I mean, what happened in 2020, in 2019, he already tried to start digging us out of Bernanke's zero interest rate policies, because that's not a sustainable model. It was causing tremendous distortions in this production structure, inflating management at, all the big tech firms and big media, and just like the whole world went crazy after so-called ZIRP. So Powell was trying to unravel this in 2019, but the Trump administration started railing against him like he was trying to cause a recession. So he started dialing that back. And then when the great pandemic hit, Powell completely sold his soul and engaged in a Weimar-style monetary policy. By the time he figured out that he was being trolled and got angry about it and started trying to get control of the inflation, it was really too late. And just so people understand, it's not as if the Fed is capable of directly reversing its policies of the past. I mean, once you unleash 6.5 trillion new dollars, 5.3% of trillion of those trillions of new dollars landed in the banking system. Once you do that, that new money has to become endemic in the form of higher prices. And that's what we've seen unfold over the better part of 2 years and 4 months. So there's nothing the Fed can do to stop that. But what they can do is reverse the zero interest rate policies and stop doing ever more damage. Now that, poses a risk when the velocity remains, basically far below what it was in 2019, that you're actually going to end up crushing the money, the pace of increase of money, to the point that it actually is, you are sucking money out of the economy because the banks are no longer lending. And that seems to be where we are right now. So there's a danger that the Fed, in its attempt to try to fix the errors of the past, actually create more problems and drive conditions that lead to recession. That seems to be where we are today.
Right. Now, you also mentioned the banking crisis. I mean, we saw Signature Bank and Silicon Valley Bank fail in the US, or were claimed to fail, but then we saw Credit Suisse fail. Now, it was odd because regulators in the United States pinned some of the blame on the crypto sector. They basically said these banks were doing very risky things. These banks were, Silicon Valley Bank was affiliated with crypto, but was very much in speculative tech stocks. And then Signature Bank was one of the handful of remaining banks that would actually do business with crypto firms in the United States. Yeah. So regulators in the US were pointing the finger at crypto, but then we have Credit Suisse fail. And Credit Suisse seems very much to be what you're talking about, which is the rapid repricing of debt, the rapid repricing, the change of interest rates being something that even regular, credible banks with a track record who are not all in on crypto are still can blow up from that. So what do you really think is driving the broader banking crisis, if it isn't this boogeyman of crypto?
Yeah, it wasn't crypto. I mean, yes, of course, Silicon Valley Bank had too many risky investments, but in this environment, what's not a risky investment, honestly? But the regulators had told the banks that the safest place for the money is in U.S. Treasuries of various maturities. So they were buying maturities that were paying the most, which, all of which are on the right side of the yield curve, so 3, 5, 10, 30 years. And that's where they were holding the money, which was great until the Federal Reserve policy changed and therefore devalued the asset portfolios of all these banks. And by the way, they couldn't find any other market for this stuff. I mean, it's not as if, you can't sit on $5.3 trillion and find markets that are viable for this kind of money. So they were making the right decisions. The problem was that they should have sold their assets at a market loss when they could, just like Citibank did. But instead, they just weren't paying very close attention. And then there was a huge demand on cash from a lot of their borrowers because the costs of servicing those loans were rising for many industries, of course. So they started drawing down on their cash balances at the same time markets started repricing their assets. And, that kind of leverage in this kind of environment just led them to go belly up. Now, the only reason we haven't seen it spread, the contagion happen, the only reason, it's not because other banks don't have these problems, but because Janet Yellen came in along and basically promised a Weimar-style inflation. Now, what was funny to me about Janet Yellen's unbelievably irresponsible announcement about that is that it directly contradicts the policy of the Federal Reserve. So that's a major problem when you got the Federal Reserve screaming about the need for tight money and a terminal interest rate above, existing inflation rate, which would need to guarantee that you have to do more interest rates in the future. I mean, just no matter how you look at it, that's what you have to do, especially if you want to repeat the experience of Volcker in 1979. At the same time, you got the federal government with the Treasury just announcing through press conferences that they're going to bail out every single deposit, which is, the liabilities of that are in tens of trillions, which is going to necessitate more dovish policies for the Federal Reserve just because the Treasuries are going to be creating the debt on its own. And it's got to find a market. And the job of the Federal Reserve is always to be, of course, the buyer of last resort of government debt. I mean, people talk about a dual mandate from the Fed over inflation and unemployment. That's nonsense. They have a single mandate, and that's always to keep the government liquid. so
that's right. Not at all like the ECB. The ECB can credibly, at least maybe 15 years ago, the ECB could credibly claim that they had a single mandate, laser focused on inflation. This is the Trichet years. And we can't, it's arguable that the Fed can't even claim it as part of its dual mandate at this point. No. So anyway, I guess that's a long way of saying that Powell is just playing the game and he's rolling with the punches, and it's a catastrophically bad monetary policy. But again, at every step, he made the decisions that he felt like he had to make at the time. So you back off from it and it looks terrible. But if you're in the thick of it, it seemed like he was doing the right thing at the right time. Do you think that's potentially the calculation we're seeing here is that because markets have been asking this question for over a year now, can we avoid a recession while getting interest rates under control? And maybe the answer they've arrived at is, well, we'll have half of the federal government claiming that inflation is the be-all, end-all. We'll have the other half of the federal government that's really involved in this area, making sure that they're just going to backstop everybody and no one's going to lose any money. And that's your real dual mandate is. Treasury is going to guarantee growth, and the Federal Reserve is going to guarantee inflation gets under control, and both of them are at complete cross purposes, and we're just going to see how that goes.
Yeah, that's a funny dual mandate: inflate and deflate. One of the worries that I had when I saw the PPI yesterday was that. And let's just keep in mind the PPI, however temporarily, registered everything is down across the board, everything. So it wasn't the case that there was even one hotspot in every aspect of the producer price index that I looked at. So now you could say, well, is that a consequence of Federal Reserve policy? Is that working? And presumably, it's the case that whatever happens in the producer sector 3-4 months later begins to show itself in the consumer sector. I mean, that's with the exception of the price of bugs, everything has to be produced, and so the consumer sector will reflect the PPI trends down the line. Now, the question is, why did the PPI come in as it did? And now there could be two reasons. I mean, one would be that the Federal Reserve's interest rate policies are working to achieve what they want. The other could be that it's just a good, solid sign of an old-fashioned recession that's developing. And to test that proposition, I looked at manufacturing sector, and I tell you what, there is every sign of a real, statistical recession that is pending, if not already here. I mean, sometimes this stuff is really obvious in retrospect, and my own view is that probably we never got out of the recession of March 2020. Nonetheless, people like to look at the data. It looks, for all the world, based on the manufacturing sector going back 30 years, that there's every sign that this is really, we're in a recession. And that, more than anything else, could account for the decline in the PPI. Just a straight loss in demand for manufactured products and a decline in productivity overall. In fact, if I were going to bet, I would say that's my best bet.
Right. So it's the demand of the industrial sector going down. It's not that prices are getting under control for industry.
Right.
It's that industry simply isn't buying as much because industry is pricing in lower demand across the board from the consumer, from everyone.
Yeah, and that's not a monetary effect. That is an effect, or at least it's not directly a monetary effect. It's an indication of growing shabby economic conditions. And here's the thing: you can always kill inflation by killing the economy itself, right? So is that where we're going with this? And I tell you,
the baby with the bathwater. That's right.
Yeah. And I tell you what's troubling about this, mostly, central bankers have a funny rule among themselves. It's like the Fight Club. The first rule of the Fight Club is that there is no Fight Club, right? So the first rule of central banking is that inflation is not caused by excess money growth. I mean, they always deny it, and they do it with a straight face, even though they all know otherwise. So Powell keeps going on about this. Okay. Well, if you're not trying to restrain money growth in order to get control inflation, why are you restraining money growth? Well, there's only one other alternative, and that's that he's trying to create an economy that's less productive, less growing, less hot, trying to cool off economic conditions, which is to say he's trying to soft land the economy into a recession, and thereby as an after effect strangle inflation. As bad as inflation is, I don't think a depression is a very good alternative to that. So, but that seems to be where Powell is, and indicates all this stuff adds up to very bad news. And by the way, that's the macroeconomic outlook. From the point of view of household finance, that's where the real problems are appearing right now, because you've got credit card debt still rising and rising despite soaring interest rates. So as real income has been, dramatically declined, and we're still not back to where we were before in pre-lockdown days in terms of real income. So at times of real income decline, job insecurity rising among the upper echelon of the employment sector, especially in tech and all the Zoom workers who had a glorious time for 2 to 3 years, during lockdowns. Now they're facing a great deal of job insecurity. So household finance is a serious problem. The savings rates have not responded to increased return in money markets as for 2 years, and we're nowhere near I think we're last I checked, we're like 3.2%. So you've got basically households not saving, real income declining, credit card debt soaring while paying ever higher rates. I mean, there's only one possible way that can go.
That sounds a lot like stagflation,
everlasting.
doesn't it? That sounds a lot like a stagflation
Yeah.
scenario.
Yeah. And also, just a grave decline in consumption. And this has been for many years a demand-driven economy. So
right. So
declines,
this is the big question mark is, let's say we get this or that aspect of the situation under control. Let's say we get inflation under control. Then and we've slowed the economy down. Then it's the American consumer that's supposed to come charging to the rescue, and they're supposed to start spending with all this money.
Yeah.
What money?
That's right.
So this is it's a very disturbing scenario. It's kind of like you've really painted yourself into a corner.
Right. I'm going to go out on a limb and say that the recession will be obvious to everybody in the summer at the same time inflation starts getting below, to 3% lower. It'll all happen at the same time. So that's what I'm seeing right now, and then you've still got a lot of money sloshing around, and it could end up landing in places like gold, and Bitcoin, but it could also still be fueling financials. Now, what is the room for the federal government to enact at that point something like a Keynesian style boost in aggregate demand? I would say that there's almost no chance.
You don't think that the green revolution can take off again? You don't think that we'll have massive infrastructure programs?
Well, I seriously doubt that that's going to be possible, especially since the Biden administration is obviously facing grave political trouble, and they're going to be coming up to an election, and the Republicans have no taste for that right now. But that's not stopping us. So here's the other thing. You really need to go back in time and understand the last time we found ourselves in this situation was in 1980 and 1981 kind of period, right? But what you had back then was a real sort of intellectual revolution taking place, where people had come to the conclusion, I think correctly, that the best way to grow yourself out of an inflationary stagflation is through economic growth. It's by spurring enterprise and entrepreneurship and leaving more money in the hands of capital and workers through dramatic tax cuts and deregulation. That was all the rage, right? That was the way to end the miasma. These days, you don't hear, there's no talk about this at all. In fact, it's like we've got a pro-miasma. Is that what they called it? Miasma? They called it, yeah. But we've got a low growth administration in charge. So they're deprivation and austerity are the watchwords of the day.
It was pro-malaise. Yeah. That's right.
I call it miasma. Yeah, malaise. That's
a miasma of pro-malaise sentiment.
Yeah, pro-malaise sentiment. To end fossil fuels. I mean, just a few days ago, they're talking about water rationing out of the Colorado River. The more fuel economy standards for cars and mandates for electric vehicles, which is ridiculous because it
really does sound a lot like the 70s, doesn't it? It really does sound like the last time we had stagflation, but without this, without anyone coming to the rescue in the sense of a bold new policy to run right against it. I mean, the Republican Party hasn't exactly been against the growth of the money supply or the deficit. No. I don't think either party has shown any interest in getting out of the way of this.
No, this is the single most alarming thing about the times in which we live, is that both parties, neither party is concerned about government spending. You don't hear anything about the need for tax cuts. There's nothing like that is going on anymore, and that makes it very different from the situation in 1978 and 1979. So it's a tremendously worrying situation for the entire macroeconomic environment. And at the same time, you've got a real challenge taking place to the dollar as the international reserve currency.
That's right.
It has been since since 1944. So you've got these gigantic economic powerhouses from Saudi Arabia to Russia to Brazil to China, all and India, all rallying around anything but the dollar. And this is a direct consequence, and it's a rational decision. I mean, after the U.S. started confiscating assets in Russia to fulfill its sanctions nonsense, it was a huge mistake. They started confiscating any dollar-denominated assets, presuming that they somehow belong to our nation. So the dollar became aggressively non-neutral in a geopolitical sense. I mean, you could say that has been true for a long time, but this time it was like aggressively true.
Right.
So if you want to conduct a sovereign economic policy or a foreign policy or just be a sovereign nation, the message that sent was have nothing to do with the US dollar. So this should not be a surprise. I mean, once again, it's so frustrating to watch economics and politics today because everything is so unbelievably obvious. Like, don't do that or this will happen. They do that anyway, and then they're shocked that happens.
That's right.
It's just frustrating. Like, really, a seventh grader with a basic understanding of cause and effect could predict all this stuff.
Yeah, well, I wanted to touch on the weaponization of the dollar and de-dollarization as a consequence. So we've really seen a lot of that over the last year. We've seen every week brings new announcements of new trades being done for natural gas, for oil, being done between countries with not using the US dollar at all, using their own currencies, using something else. We're seeing a lot of trade being done directly in gold, especially by Russia, just simply flying gold around and paying for things in gold. Do you think that these dollar moves that we've seen are effectively pushing people? Because we're seeing, kind of coming back to the crypto and gold story we've been seeing recently, we're seeing strength there. Is a lot of this being driven by traditional investors, prudent investors who would much rather be in treasuries, would much rather be in equities, who are seeing this and saying, maybe we need to be in gold, maybe we need to be getting into this crypto thing because we absolutely cannot be in all of these other assets. In other words, is the strength of gold, obviously US dollar weakness will help Bitcoin, it will help gold, but is some of this potentially sustained strength, which is really just being driven by de-dollarization itself?
De-dollarization has interesting effects on the U.S. in my read of the situation. I'm not so sure that it's going to somehow benefit Bitcoin and gold, although it very well could. I also don't believe that what they call de-dollarization is going to happen anytime soon. It just means a sort of a slow diminution in the scale of the market for U.S. debt. I think that's the big problem. And so it's going to put strange new pressures on U.S. policymakers, and they won't even know how to deal with it because, I mean, for decades the U.S. has been in the position of basically exporting its inflation, right? So the U.S. runs ginormous debts all over the place, but it can always find a market for that in somebody else's central bank asset balances. Somewhere in the world, there's always going to be somebody. But if people start rejecting the dollars, then the U.S. becomes a normal country, right? And then we're facing new pressure to balance the books or face ever higher interest rates here at home. So this is going to be a completely new challenge for U.S. policymakers. I mean, the U.S. Congress is going to have to is going to be playing a completely different game in the future. And I for one, really welcome that. I mean, that's been a very bad policy for both the U.S. and the world, for the U.S. to be this reserve currency of the world. It's going to require a new levels of fiscal discipline at home, and that could have other effects that we're not aware of yet. And people do need to keep in mind, because there's a lot of confusion about that. There's two ways you can value the dollar. One is in terms of goods and services, whether domestically or internationally, and the other is the value of the dollar in terms of its relationship to other currencies. Okay, so when we talk about de-dollarization, we're talking about the second form of valuation. The dollar as priced in terms of other currencies, not in terms of goods and services. Those are really separate categories. I just mentioned that only because I'm astonished at the number of otherwise sophisticated people that don't seem to understand that.
Right. So when they say the dollar's doing just fine, what they mean is the dollar is the smallest loser compared to all of the other fiat currencies. Not that the dollar is doing well or that the fundamentals that ought to be supporting the strength of the dollar are good,
Right.
just that the dollar is losing value slower than other currencies is essentially what it is.
Yeah, and so in terms of its price, so the dollar can, and we've seen this actually for 2 years, the dollar has gained value in terms of all of the currencies around the world, at the same time dramatically losing value in terms of its purchasing power of goods and services domestically and even internationally. Now, the international equation there is very interesting because on one hand, the dollar is very strong. On the other hand, it's not as strong as it would be in absence of inflation, right?
Right. So inflation is essentially outstripping all the currencies. The U.S. is just losing a little slower. It's losing a lot.
Yeah.
But as long as you're comparing it to currencies falling even further behind, relatively speaking, it looks good, and that's very illusory.
Yeah, and for Americans that are wealthy enough to travel abroad, I mean, they've benefited enormously, over the last 2 years. I mean, this has been a great time to move to Mexico, for example. As an American, I mean, you live like a king, and it's and basically escape domestic price inflation. So if the dollar actually starts losing its strength international as a reserve currency, those days could come to an end, and that'll be a real trap. So then dollar holders will be trapped on both ends, both domestically and internationally, and that could be very dark times. Wow, I did not intend this interview to be just nothing but gloom and doom, but unfortunately, I don't actually see anything but gloom and doom in the regular economic life.
Right. Well, maybe we can try closing on a bit more of a positive note.
Which is why there's a lot of attraction to gold and Bitcoin right now.
Exactly. Yeah. Well, I wanted to end on that, just getting a sense from you of where should people be putting their money? Again, assuming that the story might be similar to the U.S. dollar story, where things are going to lose in the short term. Things may be losing in absolute terms, but where relatively speaking, ought people to be in a stagflationary environment and in an age, unlike the 70s, where we have something like crypto, is gold a part of that picture? Is Bitcoin a part of that picture? To what degree?
Yeah, I think both very much. You can never go wrong with gold. And keep it in mind, we're going to hit new highs in the gold price here very soon. But adjusted for inflation, it's not a new high. And I haven't adjusted the numbers, so I don't know the exact dates. But gold is the golden constant, right? I mean, it's going to be there for you no matter what. And so that in times of upheaval is very much to be valued. Bitcoin is the newest member of this sort of safe haven family, and it really is something that is a smart investment for people willing to take high risks. So there's that. And I'll tell you something else. I don't believe we're anywhere near done with the demographic upheaval in this country. The migration, which hardly anybody writes or talks about in this country, has been unbelievable. I was speaking to a crowd of 2,000 people about a month back, and I said, how many people in this room are living in a new community, have a new job, or otherwise have been through some sort of upheaval in your domestic arrangements or professional arrangements in the last 3 years? And I swear to you, every single hand went up.
That's right. We're seeing enormous flows of people between states. So obviously, we've been seeing net emigration from the South. So we don't have the problem of tons of Mexicans trying to move to the United States. In fact, it's been the opposite for some time, but in net terms, right? So, but now we're seeing enormous numbers of people moving from California to Texas. We're seeing people moving to Georgia. We're essentially seeing people fleeing high tax and high cost of living states.
Yep. So I tell you what's been a great investment. It's going to continue to be a great performer over the coming years. red state real estate. So you heard it here first, or maybe last, but that's a great place for your attention and focus right now.
All right.
Florida, Georgia, the Carolinas, Texas. It's madness. I live in the Northeast, and there's nothing but bargains around here, I can tell you.
I imagine. Well, I guess that's a bit of a silver lining if you're in the right place or if you're able to get there.
Well, that's the problem with the Northeast right now. Is like you're astonished at the bargains. On the other hand, you don't know if waiting 6 months you're going to get even more of a bargain, which is likely true. So if things are constantly sinking in value, you don't really know when the point is where you're snapping up a bargain, or is it a losing proposition to invest yourself at all in these blue states, which are completely dedicated to destroying your standard of living. I mean, it's with no prospect of a turnaround either. So these are things to think about.
Definitely, this is fascinating stuff. I guess we tried to end on a positive note, but darkness pervades, a miasma of darkness, as it were.
Yes. Yes.
Thank you so much, Jeffrey. This was absolutely fascinating, and we're going to have to check back with you, I guess, over the summer when, as you say, interest rates should. The inflation should be, we should have proof of recession even after inflation potentially comes under control.
I believe that's true. That's what I'm going to say for now. I think we're looking at middle of July, early August. All the signs will be surrounded by it. Yeah.
All right. So. Well, thank you very much for taking the time to talk to us today.
Okay. Such a pleasure. Thank you.
You're watching Kitco News. Stay tuned for more coverage of what moves markets, and don't forget to subscribe to our channel.